Hi, Adam Gower here, and welcome to the real estate crowdfunding show Syndication in the digital age at gowercrowd.com with guests Spencer Levy, global client strategist and senior economic advisor at CBRE, the largest commercial real estate firm in the world. In today's conversation, we cover a range of timely topics, all relevant in today's economic climate. And as one of the country's foremost thought leaders in commercial real estate, you're going to be learning a lot from Spencer. If you've not already done so, please subscribe to the Gower Crowd newsletter by going to gowercrowd.com. It's totally free and with the only resource on the web that focuses exclusively on the real estate, crowdfunding and syndication industry, providing resources, news and updates for both real estate syndicators raising capital and individual investors looking for places to invest their money. All there at gowercrowd.com. Just hit the subscribe button to sign up. All right, let's get to Spencer and dive into what the markets are doing today, mid-September 2022, and find out where we are headed. Here we go. Spencer, thank you so much for joining me again. It's a real pleasure to see you. The last time we spoke, actually the first time we spoke, was during COVID, right at the very beginning of COVID. And we talked about a fascinating research paper that you'd done on cap rates. So let's start in the same place. And let me ask you this. With rising interest rates, are you seeing cap rates rising and reductions in pricing at the moment? What's going on with cap rates? What's going on with pricing?
There has always been a historic relationship between interest rates and cap rates. And one of the great holy grails of the business is what is the exact relationship between the two. That said, there is a relationship, it's real, and it impacts different asset classes differently. And the reason for that is because cap rates aren't just a reflection of the cost of debt capital. They are also a reflection of growth rates or expected growth rates of rent and other risk factors. It's because of those other factors that cap rates are going up in all asset classes, but some more than others. And so the asset classes where the cap rates are going up, but perhaps the least, is in industrial and in multifamily. And the reason for that is because they have the best rent growth projections. The cap rates that are going up the most is in office, and somewhere in between that is retail and hotels, which, notwithstanding the fact that they tend to be historically volatile asset types, retail has great fundamentals, as do hotels that are in leisure or drive-to locations. Now, the amount of the rise in cap rates, it's easy for me to say about 75 basis points. And that's about right if you look at an average across the board. But there are some that are much more than that, and those would be in the value add office space, where I've been saying it's about 150 basis points. And there are some that are less than that, which are the best located assets. But nevertheless, 75 to 100 basis points is a pretty good average change if one were to estimate it, though the better assets are less than that, the more challenged ones are worse.
That's really interesting. But what about the relationship between what investors are looking for in terms of yield and returns as the risk-free rates start to climb? Aren't they still looking for the same spreads to risky alternative investments like commercial real estate, and that's pushing everything up? Is that a floating boat?
It is a floating boat, to use your example, because investors have not changed their return expectations. When investors, large institutional investors, go to their raise a fund or go to a separate account, they say, we're going to get you an X% return. And they're not going to change that X% return because market conditions have changed. And so what they're going to do is one of two things. They're either going to put their pencils down for a moment, which many of my clients have, or they're going to change their strategies. And so some of the changing strategies that people talk about today, many of my clients have gotten into the lending business. They now are doing higher leverage lending because the bank and the conduit and other markets really aren't liquid today, or certainly not liquid for some of the riskier asset types. Some of them are buying public securities because there's an arbitrage opportunity between public and private values. Others are looking at opportunities created by the volatility. So one of them is that the US dollar has gotten a lot stronger relative to most foreign currencies. And so because of that, certain places like Europe, certain places in Asia are quote unquote on sale relative to the value in the US. because the US dollar has gotten so much stronger. So there are ways to adapt to the rising interest rate environment and maintain your returns, but it will require you in some cases to change your strategy.
That's some serious diversification to be looking overseas. There's certainly the dollar's strengthening is extraordinary. I was actually looking at a deal in England, of course, just a few months ago when the dollar was at $1.33. And I think it's $1.14 now. That's a ginormous shift. Are you seeing capital moving overseas as things change here?
Well, we've definitely seen that and I don't typically speak about single family or condos, but we have definitely seen that in single family and condos. But I think that in commercial, you're going to see more of that as well. We haven't seen a flood of it yet. And what we have seen, though, is a slowing flood of foreign capital coming here because we have gotten more expensive. So certain countries like South Korea, where the yuan has gotten materially devalued, we're going to see less of that capital, while some countries like Israel, where they have seen a material improvement in the value of the shekel, you're going to see more of that capital coming here. So you look at the relative value when you try to anticipate where the capital is going to be coming from and going to.
Spencer, you mentioned your clients. You talked about my clients. Tell me, just give me a sense of who they are in terms of their characteristics. When you talk about your clients, you're talking about individual sponsors, institutional investors. Just kind of give me a sense of who that is that you're talking about.
Sure. Well, most of my clients are the largest institutional investors in the world. These are household names. I'm not going to name them on the show, but you can guess them all.
Right.
And what they do is they have either a series of funds, a series of separate accounts and funds. Many of them have publicly traded vehicles as well. And most of them that I deal with have assets under management in the tens of billions of dollars or more. That said, I also deal with many smaller operators, and smaller still, generally speaking, these days is multi-billion dollars, who tend to be the operating partners of these very same large institutional investors. I deal with a lot of developers who are the builders for many of these investors. So I run the gamut, except I typically don't deal with the private capital market, the very small transactions.
And what's institutional investors doing? You kind of alluded to it, but are they sitting on the sidelines? Just give me a sense of what's going on with their capital.
They're all over the map. There are some institutional investors that are sitting on their hands, pencils down. There are others that see the world the way that I've just suggested, that there are opportunities created by the dislocation in some of these unusual suspect areas that I mentioned before. But let me be very clear. I love industrial and multifamily. Even with the rise in cap rates, the long-term outlook for those two asset classes isn't good, it's great. And because of that, you can afford to buy all cash, because you would get negative leverage if you were to put debt on it today, because the cost of debt has gone above the cap rate. And because of that, I still love them. And by the way, you know what else I love? And this will probably get me thrown off the show. I love open air retail, because open air retail has been devalued by the institutional marketplace because they got hurt so badly in it in the last 10 years. But the spread between the cap rates and the debt cost of debt could be 300-400 basis points. And yes, this will definitely get me thrown off the show. I like well-positioned office too. I'm even telling my clients, if you go to a terrific submarket, like a Midtown in Atlanta, like a Fulton Market in Chicago, like a Wynwood in Miami, like Santa Monica in California, like the Hudson Yards area in New York. Folks, I do this for a living, so I can name every submarket in the United States. Those are great places because you are going to draw clients not only from the market to your buildings, but you will draw some clients from outside the market. So there was that old movie, Field of Dreams. They say, if you build it, they will come. I stand by that, because that has proven to be the case, because new has always been the new. But now having a new building that's environmentally conscious, not just conscious, but obviously doing all the modern amenities, having great live, work, play around it, never been more important, as the scarcity of labor is by far the number one problem we have globally right now. And the only way to solve that problem is have the better mousetrap, have the better office.
That's extremely interesting that you should be talking about that. So we have clients in LA office market and Tampa office market. And it seems like it is a tale of two cities. What is where are you seeing the biggest growth in office, or where's your biggest confidence in office, and where are you seeing the biggest declines?
I'll give you the obvious answer, then I'll give you the less obvious answer.
Okay.
I think the obvious answer is the one that most people suggest, is that the Southeast, Southwest, and Texas is where it's at, right? That's a very obvious answer, because that's where the demographic flows are going. People are going to Nashville, they're going to Raleigh, they're going to Tampa, they're going to Orlando, they're going to Austin, okay? I got all that. But everybody sees that. That's why I like some of these submarkets and some of these might otherwise be disfavored markets as great places to be. Because we did a study last year on San Francisco and New York versus Austin, Texas. And what did it show? It showed that more people are moving to Austin, Texas than New York and San Francisco. But what it also showed was that the most highly educated, dare I say it, highly talented and productive people are still disproportionately going to San Francisco and New York and Chicago and LA. Now, I'm not saying you need to go to the same areas in LA and Chicago and San Fran that you've gone in the past. What I am saying, if you find the right submarkets in those places, I would be backing up the truck. I am that bullish on the best submarkets in these major metros.
Really? Yeah, so what's the again, we met during COVID, right at the beginning of COVID. What's been the impact in terms of demographics and the way people work on the office market?
Well, I think you nailed the actual issue we're dealing with here today. The issue we're dealing with today isn't a real estate issue. It's a labor versus management issue. And I'm now looking on my desk for a copy of my labor economics book, which I sometimes show at this point during shows like this. I'm a labor guy. I studied labor in college at the Cornell School of Industrial Labor Relations. In fact, I just spoke to the dean, Alex Colvin, the other day, who was on my podcast the other day. And what we're seeing today is, because the unemployment rate is so low, because it's so tight, you're seeing a shift in labor versus management power. That's just the way it is. And by the way, you know how long that teeter-totter's been going on? Since the beginning of time. And so, at some points, labor has more power. I think labor was probably most powerful in America during the 1950s, during the height of the union period. Labor maybe was least powerful during the end of the GFC, when there was a high unemployment rate, right? So unemployment and other factors lead to labor versus management power shifting. But it really comes down to the two factors that I learned when I was at the Cornell School of Industrial Labor Relations. Was when we were there, we learned that labor had both perfect information and perfect mobility. Those ideas, when I learned them in the 80s, were false. It wasn't true. You know when they were true? During COVID.
Yeah.
They had perfect information. They knew what everybody else was doing and getting, and perfect mobility, not only in the form of driving from place A to place B, but being able to work on Zoom. That's pretty close to perfect mobility. And that's why we've seen this shift in how people work, to wanting to be more hybrid, to wanting to be more work from home.
So what are the characteristics of places that have strong office markets that make the difference? Is it location or amenities that those office buildings have? Is it proximity to residential areas? So the commutes are shrinking. Like, what's driving these submarkets?
Well, it's many of the factors that you just mentioned, but what we've seen is a change in the way people live, work, and play. It used to be you live in the suburbs, you work in the city, and you play someplace else, right? You go to the ballpark or the golf course or wherever it is that you play. Now they're all in the same place. And that's where we're seeing the optimal locations for new office. So I was right next to Madison Square Garden the other day, and a beautiful building being built there, or being redeveloped there by one of our clients. And, it was a secondary office location. Now it's going to be primary. Why? Subway's right underneath. Madison Square Garden's right there. They're modernizing the building. Hudson Yards is 2 blocks away, which is where you're seeing a lot of the activity. And why are you seeing it not just next to Madison Square Garden? You're seeing it next to the ballparks in Kansas City. The ballpark in Washington, D.C. is one of the hottest areas, the Navy Yards. People want to live, work, and play in the same place. The Wharf in Washington, D.C., terrific example. What we're going to see in Crystal City, same thing, where people can live, work, and play in the same place. So yes, things that have live, work, play characteristics like I'm describing, those are the optimal office locations.
One of the things that we're seeing clients' experiences retrading of loan terms from banks. What are you seeing, or what's going on in the debt markets that's impacting commercial real estate and transactional activity?
Well, I don't want to be too negative on this, but it's very challenging right now in the debt capital markets. It's challenging because many of the traditional lenders are out of the market. And that would include many of what we call the money center banks, the banks on Wall Street, big banks that you know, because they're either not lending or they're lending only to their very, very top tier clients. Conduits aren't lending because spreads are so wide on, particularly once you get to the lower tranches. Debt funds are having trouble lending because they're too expensive. And then if you're in a challenged asset class like value add office, it's tough to get a loan at all. That said, if you're in multifamily, Fannie and Freddie, thank you very much. Keep lending because they are maintaining liquidity in that market, even though it's more expensive. Industrial, you can still get loans. And guess what? You can still get loans in retail and hotels at a positive spread. Even though you might be paying close to 6% for your money, you're still paying a 9 in your cap rate. You got 300 basis points built in. And so the bottom line is this: the debt capital market's very challenged. It's the number one issue causing illiquidity in the capital markets overall today. And we're not going to see that materially improve until we see a downward slope, not only on interest rates, but spreads. And the spreads will come in once we see some CPI improvement. This last print that we had on September 13th this week was another unwelcome shock to the market.
Yeah, exactly. So with institutions, it doesn't matter that it's not all of them, but with some of your institutional clients pulling back and debt markets tightening up, isn't liquidity the key driver to pricing in commercial real estate? And you kind of give this sense that we're not moving into a period of distress, but these two factors impacting liquidity suggest that perhaps we are. What do you think?
I have a dear friend of mine who I will name. His name is Russell Ingram. He is in our Dallas office. And Russell and I have been having this very debate for 15 years about what matters more, fundamentals or funds flows. And I have always been in the camp of funds flows, or liquidity, as you put it, Adam. He's always been in the camp of fundamentals. And so there's no right answer to this question, but fundamentals matter over the long term. Over the short term, liquidity matters more.
How is inflation impacting commercial real estate activity?
Well, there's two ways to look at that. One is the spot market where we are at the moment, and the other is the long-term outlook. So at the spot market where we are at the moment, we are at a period of what I would say is maximum stress or volatility. But over the long term, we expect inflation to come down, and we expect it to be near normal levels by the end of 23. And near normal is 2.5%, may not be 2%, but near normal levels. The reason why we're not going to get necessarily back to that 2% level, which is the Fed's target rate, is because the labor market is so tight. Unless we see a significant loosening of the labor market, hard to see how you get back down to 2% flat. But nevertheless, so if you look at it in the short term, and it's easy for me to say, well, don't look at the short term, look at the long term. But most of my clients have to mark to market their assets on a quarterly basis. So they can't ignore the short term at all. That said, we are in the long-term business. Clients that can ride out this storm not only will have great value over time, but will have opportunities to buy today as well.
So what's causing inflation? I think some of the answers may be obvious, but I'm going to ask you anyway. What's causing inflation? And why do you think that by the end of 23, which is a year away, we'll be back to normality? Is this an aberration, you think, that we're seeing in inflation now?
Well, we certainly hope it's an aberration, but there's certainly evidence that it is an aberration related to things such as the supply chain woes that we had, which are working themselves out. The war in Ukraine is seriously putting pressure on the price of energy. And I will quote my favorite economist in the world. And if you're listening to this, Professor Thaler, please come on my show or this one anytime, because I think you're terrific. Richard Thaler, a Nobel Prize winning economist from University of Chicago, is considered to be one of the founders of what's known as behavioral economics. He was on TV the other day, and he said he saw no mathematical way that we could enter into a recession because of the tightness of the labor market, because of how strong demand is. He believes that much of the inflationary pressures we're seeing is largely due to supply chain issues. I'm going with Professor Thaler's opinion
Really?
because there's no economist I have greater respect for than him. Now, could we be wrong on timing? Could inflation last longer? Sure, it could. But I think the Fed is committed to bringing it down, and I still think there's a reasonable chance of a soft landing.
Between now and the end of 2023, are you anticipating that there will be distressed opportunistic acquisition opportunities for sponsors in the market?
Are you asking, will there be more distressed opportunities between now and the end of the year?
End of next year.
End of next year? Oh, yeah, absolutely. Because you're already going to see people that are in the home building space stressed because buyers aren't buying. The average cost of a single family home mortgage breached 6% for the first time in 15 years yesterday. And many of them build townhomes. Some of them build multifamily. So I think there's going to be opportunities for well-capitalized institutional investors to help there. I think you're also going to see opportunities in the office sector where many of these office buildings that are need a tremendous amount of CapEx need a better capital partner. And some of these office buildings are in great submarkets. And so I think that there will be opportunities there. But I think also, if you look at some of the asset classes I mentioned before, multifamily, industrial, hotels, and retail, there are opportunities there right now that aren't even distressed, just regular assets that are performing well, where you can get them at a huge discount to where you could have gotten them 8 months ago. So you don't have to wait for the sky to fall to find good opportunities.
What about multifamily investors who put together their deals 3 to 5 years ago, projecting an exit now, who didn't anticipate interest rates or cap rate changes as they are doing now? What's going to be happening to their deal results for their investors, do you think?
So let me just give you something one of my clients said to me. This was industrial, not multifamily, but I can make a similar case for multifamily. He said that in 2021, last year, they made 15 years of promotes of carried interest in 1 year, last year. Why? Because
that's crazy.
Cap rates had come down so much and fundamentals were so good. Okay, fast forward to this year. Fundamentals are still scorching hot good, but cap rates are not. You still have a tremendous amount of pent-up gain in industrial and multifamily for people who got into this 3 to 5 years ago. So there's still great opportunity to get out today at a profit. But if you were to hold, you're going to benefit from improving NOI over the next 2 years, and the cap rates will be better 2 years from now than they are at the moment.
I see. So your point is that those that came in 3 to 5 years ago have outstripped their projections. So anything that's happening now is just kind of backing into what they did project. Is that?
I think that they probably undercounted how much NOI would go out, but they probably overcounted how low cap rates were going to be, because cap rates are definitely higher than we would have anticipated 2 or 3 years ago.
Now, one of the best indicators of what's going on in a market is to ask one's clients en masse what's going on. So what are your clients asking you to research at the moment? How are they driving your research patterns?
Well, the number one research publication for CBRE every year is our cap rate survey. And I'm proud to say I was one of the fathers of this thing 12 years ago. When we used to have 4 of them, we consolidated them into one. And now it's one of the great devices in the industry. Now it's imperfect. It's a survey. It's not actual trade, but it is directionally excellent over time. Okay. They're asking us where cap rates are. That's probably the number one question going back to that survey. But the number 2 question is, where are the opportunities? And that's where I come back to what I was saying before about some of these direct strategies, retail, hotels, some of these indirect strategies, buying public versus private or buying overseas. But also, when you see these submarkets that have these LWP, live, work, play characteristics, that's where I see the opportunities. There's some of my clients who buy multifamily. There are some that buy industrial. There are some that buy the market. And what does it mean to buy the market? They'll buy everything in that submarket. And so we are coming out with, shameless plug, our annual Tech 30 report in a couple of weeks. I should encourage our listeners to look at last year's report and then wait for the one that's coming out in 3 weeks, because it lists these top 30 submarkets. I could not be more bullish on the 30 submarkets mentioned in that report, including and maybe especially those submarkets that are in the markets that from a macro sense may be disfavored by investors.
Did you say that a tech survey? Is that what you said?
It's called a Tech 30 report, the best 30 tech submarkets. Now, tech is not the only industry in the world that's growing. Life sciences, which may be a subcategory of tech, depending upon how you look at it. But nevertheless, most of these tech submarkets have these LWP characteristics by design. That's why the tech companies go there, and that's why people flock there from a live, work, play perspective, building multifamily, building cool restaurants, bars, whatever that will give people a lifestyle that they want, which is walking home rather than driving or commuting home 30 or 40 minutes.
That's really interesting. So is tech a significant driver relative to any other demographic shifts or economic characteristics to commercial real estate opportunities that you look for tech?
It is not the only driver. They are still a fraction of the overall users of space out there. Government's a big user, law, accounting, finance.
Exactly.
A lot of industries out there, but tech is probably on average the fastest growing.
That's interesting. All right, so let's wrap up with two final questions. Same question, but for different audiences. What advice do you give? So we're looking at bringing inflation down. You think inflation will reach stability or again normality by the end of next year. With that in mind, what advice do you have for sponsors who are looking at the market now? What should they be thinking about, and how should they be acting between now and then?
I think they should be first and foremost focused on their existing portfolio and how do I optimize this portfolio during this period of maximum volatility. Does not mean unloading it, may mean changing their asset management strategy to modernize it in certain ways, particularly in an ESG fashion, so that when we do come out of it, they have the best in class product. That is a strategy. Instead of buying new stuff, recapitalizing some of your existing stuff so it's the best in class when we're done. That's one thing you can do. Another thing you can do is listen to or read some of the research on where we're going in traditional asset classes, and there's still great buying opportunities, even if, and you may have a moment here where you're at max cap rates. As a matter of fact, I'll say it on air. Some of our clients believe that we've already hit maximum cap rates in industrial. I'm not sure that we've hit max cap rates in some of the other asset classes, but industrial, we're definitely seeing a significant increase in buyer appetite because there's a lot of dry powder out there. So I would say focus on your knitting, meaning your existing portfolio, but look at some of these other asset classes or traditional asset classes for great longer term opportunities. When people ask me what's the best thing to buy, I always ask the same question. What's your time horizon? If your time horizon is in the next 18 months, I'm going to have a different answer for you than if it's the next 5 to 10 years. If it's the next 5 to 10 years, back up the truck on industrial and multifamily and in office in those submarkets that have the LWP characteristics. It will come back. San Francisco, which a lot of people are down on, has historically been a very volatile market. San Francisco will come back stronger than ever.
Fascinating. All right. And then advice for individual investors. You know that my world is kind of colloquially called real estate crowdfunding. It's really syndication online where sponsors try and find investors online. So for those investors, individual high net worth investors who don't really know real estate that well, they're not in the market, but they understand they want to invest in alternative assets, what advice would you give for them for how they find deals and what to invest in?
There fortunately are a lot of very, very good sponsors out there. Not all of them are the top 10 largest sponsors in the world. A lot of them are smaller professionals, but they've been in business a long time. Find people with long multi-cycle track records and invest with them. Don't invest separately from them because you can save a few bucks on management fees by doing it directly. Bring in a pro with great track records. Many of them are smaller, and you'll find terrific opportunities to invest over the long term.
Before we do wrap up, the reports that folks should be looking out for, the tech report you've mentioned, and when did this year's cap rate report come out? Was that
this year's cap rate survey came out a couple of weeks ago, so it's brand new. The tech report's coming out. One of our tech reports came out in June, which is called our Tech Talent Report. The Tech 30 report's coming out in a couple of weeks. I would read our facilities management reports that have come out. Why am I saying that? Because what did I say about one of the top things you could be doing today as an owner is sticking to your knitting, looking at your existing asset classes, because the number one flaw in the economy today is labor shortage. And because of that labor shortage, it's more expensive to get a plumber, to get somebody to fix your HVAC, to fix your electricity. If you can modernize your facility, you won't need as much of that labor going forward. So you may have to spend a little bit of CapEx today to save a little bit of OpEx. And I'll mention one other thing. The recently passed Inflation Reduction Act is something that has tremendous incentives to pay for CapEx. Much of these CapEx is for things like HVAC, that if you modernize it, not only will be more energy efficient, but will save you OpEx going forward. And some of these multiples are significant in the IRA that can change your payback period on some of this CapEx from 7 or 8 years to 3 or 4 years. That's an enormous opportunity to look at today.
That's a fascinating insight. Spencer, as always, your insights are fascinating. Thank you so much for joining me today on the podcast.
Thank you for having me, Adam.
That was Spencer Levy, Global Client Strategist and Senior Economic Advisor at CBRE. If you've not already done so, please subscribe to the Gower Crowd newsletter by going to gowercrowd.com. It is totally free and we're the only resource on the web that focuses exclusively on the real estate crowdfunding and syndication world, providing resources, news, and updates for both real estate syndicators, raising capital, and for individuals looking for places to invest. All there at gowercrowd.com. Just hit the subscribe button to sign up. That's it. Thanks for listening. And thank you, Spencer. Always a pleasure to see you. Always a pleasure to hear your insights. Thanks so much for your time. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Adam Gower signing off.